All right, see this picture? What do you see in this picture? I see lots of little bubbles and I see froth. That's right, I see froth. And quite frankly, the word froth or frothy was used a number of times back in the previous housing crisis, around 2005, by then, I think, Fed Chairman Alan Greenspan and by Ben Bernanke to describe some markets across the U.S., some metro markets, as being somewhat frothy, and look where they ended up. But they didn't think it was that big a deal. Well, we've heard the term once again, so we're going to talk about that today. Welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Randy Patrick here, putting the realism back in real estate. I talk about the facts, or at least the facts that people want us to listen and believe and hear and talk about. So let's get into it right now. But first of all, if you're not already a subscriber to my channel, if you could do me the great honor and smash that subscribe button, I'd really appreciate that. Thank you very much. So here is the scoop, all right? This is the definition of froth, and I have to laugh because look what it says here. It says froth, a mass of bubbles in or on a liquid foam, salivary foam released as a result of disease or exhaustion, something unsubstantial or trivial, and number 4, high prices unwarranted by economic fundamentals, i.e. a housing market with a lot of froth. So the housing market has actually made it into partial definition of the word froth. So there you go, guys. So I'm not speaking out of the side of my mouth here. It's actually out there. So, and why am I talking about this? Because here is the CEO of Redfin who came on and spoke about where home prices are going. The reason we're talking about this because yesterday was the last Tuesday of the month, and what happens last Tuesday of the month? Well, Case-Shiller releases their data for the previous couple of months, 2 months back, with respect to housing price and value. So the CEO of Redfin basically was saying in this interview here, I'll put the link in the information section of the video, but the CEO of Redfin said, he's seen, it has been the frothiest market I've ever seen. So we're hearing that term froth and frothy again. So you know what? Just because people are saying it, we got a housing bubble. Simple as that. All right. So let's get it down with respect to who thinks the housing market's overpriced here? Well, the National Association of Realtors, the chief economist there basically said affordability issues, that there's some problems coming up. Realtor.com, their chief economist saying that we've got some affordability issues and high prices. And going back, the NAR guy said unhealthy market. Okay, Redfin guy here is talking froth. Economists and real estate analysts. So if you actually start to do some research and look at, third-party, non-affiliated, just people who make a living talking about the economy and markets, more than average are saying, yeah, we're in an unhealthy market as well too. The prices are too high. It's going to cause some problems, etc. Real estate investors. I mean, real estate investors. I'm talking about people who don't do one property a year or 2 properties a year. I'm talking about groups that buy 20, 30, 40 a month. People that I know personally that have over 100 rental properties or own, a few hundred doors in multifamily and stuff. So when I talk to my colleagues and my contacts in that strata, they all know it's overpriced and they're waiting for things to actually happen. Keith Juro, and actually one of the members in my short sale program brought this to my attention. So I saw a recent video from the fall from Keith Juro, and he is an analyst that actually he's a PhD, he's an analyst that comments from he's found on Market Watch. I followed him for many years, and yeah, he doesn't even believe Case-Shiller and other statistics. So, that's, again, he feels we're overpriced, big housing bubble. Who has been remarkably quiet? Robert Shiller. So funny enough that, the person who really is the co-creator and author of the Case-Shiller Home Price Index really has said nothing about the past few months whatsoever. I think he's been remarkably quiet and hasn't commented one iota about anything. So to me, that means he doesn't know what to say, or he doesn't want to say anything. That's really what it boils down to. So we're hitting more records again. So every month it's kind of like we're hitting new median price records, sales records, price appreciation records. So, this is an example. Report shows biggest housing market gains in 15 years. Well, Ultimately, when the pandemic hit, Americans shifted from an in-office to remote work. The shift prompted many to reevaluate their housing options and supercharge demand, according to researchers at Zillow. Zillow expects bigger growth in 2021 as the sustained demand pushes home values higher. There you go. So I guess you could say that groups like Zillow and mortgage companies, whatever, they like the market where it is. They want it to go higher. They want it to increase. They want to write bigger mortgages. Lots of fun, putting more people, I think, in risky territory and causing problems for us down the road. So let's go right to the core logic stuff here, guys. I'll try to make this as brief as possible. There's a lot of data to go through. So ultimately, yesterday it was released that we went for what? Annual home price gains climbed 9.5%. That's a year-over-year number compared to November of 2019. Case-Shiller runs on sales pairs, and it also runs. It's a drag-along, tag-along indice based on the complexity of the calculation. So even though we've already talked about December existing home prices and what's going on from a real estate Realtor.com National Association Realtor perspective. Case-Shiller does the things a little differently, and they're an extra month behind. So this is November data. So ultimately, what they're talking about is a 9.5% annual gain, and that's up from 8.4% in the previous month. And all their composites really are having, 20 city 9.1 gain, 10 city 8.8 gain, and of course across the board a 9.5 gain, which is what they're talking about here. Phoenix, Seattle, San Diego continue to report the highest year-over-year gains of the 19 cities. For whatever reason, the city of Detroit is excluded from the Case-Shiller stuff because they have a difficulty providing information based on what they say is, issues with recording and the clerk and the courthouse and these type of things. So apparently they have difficulty with information. This has been going on for a number of months now in a row. So I don't really know what's going on in the Detroit area, and I'm becoming somewhat skeptical as to why we're not seeing that information from that location. So again, everything is pricing growth. When we look at the analysis, all right, so the national index posted a 1.1% month-over-month increase, all right, and trend of accelerating home prices that began in June 2020 has now reached the 6th month with November's emphatic report. The National Composite Index gained 9.5% relative to a year ago. COVID-related restrictions began to grip the economy last spring. Their effect on housing prices was unclear. Price growth decelerated in May and June before beginning a steady climb upward. November report continues that acceleration in a particularly impressive manner. So there you go. Recent data are consistent with the view that COVID has encouraged potential buyers to move from urban apartments to suburban homes. So we're seeing that shift in demographic, where you live, where you want to go. You were an apartment renter before, now you want a house or can afford a house or relocation, etc. This may represent a true secular shift in housing demand, or may simply represent an acceleration of moves that would have taken place over the next several years anyway. Future data will be required to address that question. Phoenix, Seattle, San Diego, we'll talk about that in 1 second here. I'll get into the details of each location. If we take a look at the, we'll look at some graphs now, and here's your three, I guess you could say your 10, 20 city composite lines, and the national one. The national is a dark, thick line there. You can see everything's trending upward on the right of the chart. We can see where we had our dip in the last housing crisis, and we've had a correction, and we're back down, and now we're back up again. So there you are, folks. That's what that's saying here. This is the indices going nationally across the board. Actually, all three of them, but they're not doing the year-over-year percent change. They're talking about the actual Case-Shiller index. So clearly, we can see that the last housing bubble was the 2006. And again, I talk about this every month, so this is repetitive. I get it, but you know what? I just think it's important to talk about it, to show it, because when there's changes, I want to see how this manifests through in the future. But you can see where the 2006 peak was, and we can see where the trough came in 2011 and 12, and now you can see that we're greater than the previous 2006 peak. Well, greater by how much? Well, according to the chart here, the national index, the right-hand columns are from the peak. I guess you could say, so the peak was July 2006 for the previous housing bubble. The trough was in 2012. and February, and from the peak, we're a little bit shy of 26% from the peak. So growth over last peak in 2006 is almost 26% for the national index. So that's pretty substantial if you can take a look at that. So let's go to the city by cities, which I know everyone wants to talk about. Let's do that here. All right, hold on to your horses. Here is the data. So Atlanta, the 1 year change 7.9%. Boston 10.4%, Charlotte 9.4%, Chicago 7.5%, Cleveland 9.8%, Dallas 7.2%, Denver 8.1%, Detroit no information, Las Vegas 6.8%, Los Angeles 9.1%, Miami 7.9%, Minneapolis 9.4%, New York 8.2%, Phoenix leads the way with a year-over-year of 13.8%. Portland 9.5%. San Diego comes in third place with 12.3%. San Francisco 8.3%. Seattle back up to second place at 12.7%. And then we've got Tampa 9.5%. Washington 9.1%. So really we are seeing like everything is pretty much what's the lowest value is 7.2% year over year. So we're not talking 2s and 3s and 4s anymore. We're talking 7s, 8s, 9s, 10s, and 12s. Oh, actually into the 13s. So substantial increases. Some of the locations that were having difficulty, like a Chicago, like a Cleveland, you can see have rebounded. And whether that's, again, it's the sales mix, we don't know. So there's more complexity to the equation that we're not privy to. So we don't know, how many properties transacted in these locations, et cetera, the property mix, whatever. So I know that in some locations, because we're seeing, when we look at some of the Realtor.com or NAR stuff, that we know that there is an increase in higher priced property sales, so that they're becoming a larger component of the overall sale. So that could also be propping the market up a little bit more as well too. So it's just interesting to see that where things are at. Now, when you start looking at this though, some other commentary. Home prices soar at 4.5% times the Fed's inflation target in all U.S. cities. I spoke about this before. The problem for what we see here is that the way they look at some of this inflation calculation is based on, we've got home price values increasing, but the consumer price index is based on rental property. So that's kind of interesting on how that works and why that's not changing. I don't know. Essentially, let's take a look here. Let me read. So meaning that the average home price across all of the U.S. is now rising at 4.5 times the Fed's own inflation target, and even the cheapest U.S. metro location is rising at more than 3 times the Fed's inflation goal. So really, housing is outpacing inflation as far as the Fed's goal and target is concerned. We know that housing price appreciation is outpacing wage growth and wage gains as well. Just as the guy who authored this last month said, if CPI measured actual house prices, inflation would be above 3% right now. Actual consumer price inflation is rising during the recession. That runs counter to the normal recessionary pattern when the combination of weak demand and excess capacity works to lessen inflationary pressures. The main source of faster consumer price inflation is centered in the housing market. The Case-Shiller home price index posted a 7% increase the last year, more than twice the gain of 1 year ago. The sharp acceleration in house price inflation represents the fastest increase since 2014 and runs counter to the patterns of the past 2 recessions. So that's interesting. And as I mentioned here, let me go to the next slide just so we can tag up with that. The consumer price index does not show a price inflation because it uses a non-market rent index to capture trends in housing inflation. The Bureau of Labor Statistics estimates that the true non-market rent index has increased 2.5% in the past 12 months. So again, if actual house prices were used in place of rents, core CPI would have registered a 3% gain in the past year, nearly twice the reported gain of 1.6%. So really, what we're looking at here is, I guess, not truly correct information. So when we look at inflation, the red line's the owner's rent consumer price index, so it looks like it's trending downward. And obviously, house prices we know have gone exponential for the past couple of months. So as they state here, the they don't equate. They don't make sense. They're running adverse to each other, and that's not typically what we see during a recessionary situation. So there you go. It just goes to show that that's another graph they brought out here with the composite index. You can just see how, where things were up and down and dropping. So we've gone for a little bit of a ride. We can see the previous housing crisis, and we can see the COVID crisis, and then where we are back now. So we are going back up at what I would call an exponential, tangent, I guess you could say. This is the 1 year price change percent by metro area. So you can see that they show two colors there. October blue, green is November, both for 2020. So you can take a look at, the locations that are really growing are, Phoenix, Seattle, San Diego are the top ones with respect to, the past couple of months. They've had, over 10% year over year appreciation price points. So, but everything else, the lowest level is, New York, at what, maybe just under 6%. So every location has grown. And even though a lot of these locations do have issues, we know New York City has major issues. We know that San Francisco area does have lots of condos for sale and things like that, and certain market locations are taking a hit. So we're seeing the frothiness of the bubble, sort of, I guess you could say peak froth is where we're at this point in time. So that's the scoop on that. All right, now this is interesting. So of course, when you have high prices and every month things are getting more and more out of range for a lot of people, weekly mortgage demand falls, but the size of the average home buyer loan hits a record. So this is why I talk about housing bubbles, and this is where things are going. So prices are up, so therefore the need to pay more is up. So therefore the I guess you could say the result is higher average mortgages. So we're looking at here mortgage applications to purchase a home fell 4% from last week, but were higher than 16% a year ago. The average purchase loan amount hit another record high of $395,200. So that's the average loan. That's across the board. So whether you're in New York or Florida or Denver, Dallas, or the West Coast, San Francisco Bay Area, whatever, Seattle, Boise, doesn't matter. That's the average loan now. So that's, so the average loan, I think if we go back to Realtor.com or National Association of Realtors for the month of January, for example, when the median price was almost 310,000, that's the median price for sales. The average, now median and average are different by definition. So median is exactly in the middle, and average is averaging things out from top to bottom. But just median being 309. Average purchase price is $395. I don't know. I don't know what the average existing home purchase price was last month, but it's the loan values are growing. Loan values are starting to outpace even the averages and the medians out there on the housing prices. So would one be concerned about that? Well, it depends. And I look at it going, lenders want to lend. The more expensive things are, the more cost it's going to take to purchase it, which means the bigger the loan you're going to undertake, which means the higher the risk for everybody involved, whether it's homeowner, lender, underwriters, whatever. So it certainly is growing, and seems like there's nothing in sight to stop this. However, yes, is this market artificially controlled? Sure it is. Do we have a lack of inventory? Yes, we do. Do we have incentives to go out and with low interest rates to keep buying property and increasing our buying power? Of course we do. Have we distressed property coming on the market like we used to? No, we don't. Do we have this sort of, we'll call it bubbling, pressure cooker, volcano building, of forbearances and foreclosures under the radar? Yes, we do, and they have not hit the market. We'll talk about it in the next video about forbearance and eviction moratoriums and things like that again. But I want to get just to today to the house price issue and just see where things are at. So it seems like if the market continues the way it's going now, where people are already priced out, people are already talking about buyer fatigue, and yeah, we're seeing this trend right now. But even like the Redfin guy, if you listen to what he's saying on his video, he's saying at some point in time, this has to stop, and we have to get back to reality because we can't sustain this bubble and where we're going. As simple as that, guys. All right. Next slide here. Opportunities knocking. So even though we've got these huge price point increases, when things are out of control like this and people want to buy at the peak, you know what? Time to take a look at getting involved in real estate. And I'm not suggesting that you buy at the peak and sell, and get yourself caught. I'm suggesting you buy discount through distressed sales. This is my platform. It's what I talk about. So this is really a good idea, is the fact that if we know there's going to be foreclosures coming. I'm going to show these slides every time I do a video. We're expecting 2.5 to 3 million foreclosures. Well, that number is going up. I'll talk about that again. Right now, we also have 1.1 million, 1.2 million delinquencies, not any forbearance plan. Hopefully, we'll be seeing new FHA delinquency numbers coming out in a couple days, and I'm going to review the foreclosure and forbearance numbers as well too. But we're seeing activity now that's picking up here. Even the data companies are talking about the future market opportunities. Short sales and pre-foreclosure sales are poised to become the dominant share of distressed market in 2021 and beyond. We're looking at 4 to 5 years of this, folks. So there's great opportunity coming. Yes, we're all tired of it. We're all just, I don't want to hear that. Like, I didn't even want to make this video today. Why? Because it's the same old thing over and again. And people are going to go, this guy's talking about the bubble. Bubble never bursts, right? Well, that's the part of bubbles. Bubbles grow exponentially. Bubbles get so hot and it's a mess. And then when they come crashing down, we'll see what happens. And that's where the fun begins. Now, in hot markets, what do? You find distressed property. You can fix and flip, sell to retail buyers, cash flow rental. People are flocking these locations. Remember the last video I spoke about the top 5 locations. We see, obviously, with respect to some of the Case-Shiller stuff, but the top 5 locations, according to Zillow, is Austin, Texas. We've got Sunbelt stuff, Phoenix, Tampa, where I'm at, Nashville, and Denver. That's where they're top 5 predictable hot housing markets. The ones that are not so hot and so again, people are flocking to these locations. So, here's the thing: you buy relative to the price point of where things are at. So, if you buy well, you'll make money now. You'll make money 6 months from now. All right. In cooler markets, which they talked about, were New York area, San Francisco, Los Angeles. Now, the New York area has a huge amount of pre-foreclosure sitting around there. So, people are leaving New York now. People are having financial difficulty, but we'll just see a shift. So when things open up and all these foreclosures hit the market or become available to investor buyers, other buyers, etc., then we'll see, other people will come back to those markets because those will be priced accordingly for that time with discounts for that price point. So it's simple as that. So in cooler markets, still it's the same thing. Find distressed property, fix and flip, sell to retail buyers, cash flow rental. People will flock back to these locations and there'll be price adjustments. So the point is, don't wait and hesitate. That's, I guess, my, that's my point here. With distressed property, you're always acquiring for less than retail. It's all relative to the timing. No need to wait for material discounts. That's just a fallacy, and it makes you feel better. Okay, you create your own discounts. This housing bubble is different than the previous, and why? Because there are always buyers now. So even though we do have buyers. So last time we had a lot of inventory, and then the hedge funds came in, took over that inventory. The lenders and banks controlled the inventory, created the housing recovery. This time, when we do have things starting to crack, in the housing market, we have lots of buyers waiting to jump in. So that's the thing. So getting these properties at a discount, you can move them to either investors or to retail buyers because we have more than enough buyers. So the point I'm trying to make is that if you say, I'm not going to buy a property now, because I want to wait 6 months to get even a better deal, well, then here's what's going to happen. You've missed out maybe on getting a good deal on that property now because you buy it for X now, you'll sell it for Y now. You'll make your spread. Back down, back six months forward, you may buy it for less than X. Okay, but you know what? Your spread's not going to be the same because the retail value, what you can sell it for, is going to go down as well too. So really, you're at the same point from a margin spread perspective wherever you are. So just realize that that's what goes on in housing markets. And as I said, there's always buyers, there's always opportunity. So let's take a look at it. Properties available right now. I talk about this on existing home sales from National Association of Realtors. 1% of the marketplace is distress, which is what? REOs, foreclosed, and short sales. No one's doing short sales. How do we know this? Because we go back to the 1% or less. No one's doing this, folks. Therefore, no one's helping homeowners, and these are just going to fall into foreclosure and be missed opportunities given to the banks. Big investors are going to buy it, and you're not going to buy it because you're not involved in the game. Simple as that. All right. Foreclosure filings are quietly increasing. More properties are being scheduled for foreclosure auction. Go back to that 1% rule that no one's doing this business. I'll tell you about it. Happy to engage. want more information, connect with me. Really starting to put forward a lot of stuff now, and I'll be releasing more information on some good, neat things. But the opportunities to purchase in Florida, I mean, well, some of these locations, I mean, as much as I'm, pro housing affordability and pro housing bubble, I'm also open enough to look and going, hey, let's see how we can take advantage of where we are at in this cycle to either get decent prices or make some money, etc. Because the majority of people who are out there don't look at housing. They just look, I want to buy a house and it's going to cost X, I'm going to buy it. They're not as in-depth as you guys are as actually watching videos, looking at statistics, figuring stuff out, and trying to time your purchase. So that's why let's don't be as caught up about that, and maybe get more involved in how you can make stuff work in this unique environment. All right, guys, thanks once again for the views, likes, comments. Share the video with your family and friends. Reach out to me at my email address right there, and we'll chat about real estate. Talk to you later on this week. Thanks.